So, John, what is the opportunity set, do you think? What's the biggest opportunity in the whole property sector?
I think, is this...
It's on. Hello, Christian.
I think...
Very well.
Partly one of the main opportunities is the pure size of the market in the UK, and I think it presents the platforms focused on this to potentially scale without necessarily moving down the risk curve. I think they'll hit the constraints in terms of origination much later than probably the consumer or business lenders.
Okay, so I mean, because let me look at it this way: the additional kind of real estate gap which has been identified in the kind of peer-to-peer space has been around bridge funding, for instance. And Christian, you've been doing a lot of that, and also to a degree, you've been doing that as well. Absolutely. But surely the sector's got to move beyond bridge funding. It's got to move to buy-to-let mortgages, isn't it?
Yeah, that's right.
Yeah, exactly. Now you're doing it.
Yeah, we're doing it.
But you're not.
We've been doing it for nearly a year and a half now.
And what kind of business, what origination have you two got now?
Ours is fairly minor.
Yeah.
We've been doing a little.
That's what I was thinking.
Business.
It was that too.
Absolutely.
Yeah, John?
We're a sort of relatively young platform. We completed our first mortgage in Q3 of last year. We're now doing about £1.5 million a month in February. And I think we've done 24 mortgages to date. And most of that has been in the last 3 months.
And Christian, I was slightly undecided of the bridging finance because it's a huge industry and it's a good business.
Yeah, it is, and I think there's a misperception that it is a niche area of the mortgage market, understandably, but it's still sort of $2.5 billion a year.
Really, so there's quite a lot left in it.
There's a bit of scale there. Yeah.
Yeah, and how much have you guys done so far? Because you've also got your main platform, LendInvest. You've got Montello as well, which is a fund management company.
We have, yeah. So, but if we're just counting the LendInvest side of things, it's $210 million we've done since May 2013.
So there's quite a bit more left in the marketplace. How much do you think you could double your numbers from here?
Yeah, definitely. We could double our numbers just in bridging and still be a very small percentage of the bridging market.
Okay, fine.
So,
and in buy-to-let, presumably with both of you guys, it's a really small, tiny bit of the overall market.
Yeah, I think
what you're doing at the moment.
Last year, I think the market was about 27 billion, the whole buy-to-let market, and that's still way below what it was in 2006. Of that, about half is amateur, semi-amateur landlords that are mainly serviced by the banks. So the half that we focus on, which is 12, 13 billion, is the professional, semi-professional landlords.
Again, I mean, it's small. I obviously missed it, Stuart. I apologise, but it's a small bit, so it's imminently growable.
It has been, but the news today is that we are launching buy-to-let now in full anger.
In full anger?
We're negotiating a £250 million line of funding for
£250
that.
million?
Yep.
Think modest.
Yeah, I do. It's modest. It's only a quarter of this year's line.
Tiny percentage of the market, isn't it? Yeah, exactly.
It is, and buy-to-let will become a major part of what we do in the property side of things.
Just on that, I mean, I think the buy-to-let space is a really interesting one because I think it's one where you can still provide quite a good proposition for the investors and actually be quite competitive on the borrower side. So I don't think you have to go up the risk curve just to attract, quality deal flow.
And that is the whole point.
Yeah, and that's right. I mean, most landlords have very good credit ratings, for example. We've only turned one down, which was because of adverse credit. I mean, most of them have perfect because they own multiple properties. They're generally high-quality borrowers.
Duncan, now I've known Duncan for many years. Duncan heads real estate over at Schroders. The numbers that you're dealing with are slightly larger than many of the guys' platforms around here. But that's because you're in commercial real estate, which is a big old business. You looking at you're a veteran of the industry. How do you look at the whole kind of crowdfunding space and bridge funding, beginnings of the buy-to-let funding market? What's your view on this? And actually, you probably echo a lot of John says about that cycle, that property cycle.
Yeah, absolutely. It's an interesting time in the cycle for real estate. I think crowdfunding, bridge funding, all those sorts of things, they've actually been around for decades under different labels.
Yeah, that's the issue.
About half the money that we manage at Schroders in the real estate funds is institutional and half is what's loosely described as retail.
Yeah.
But you could easily describe whether it's institutional investors or retail investors as doing similar things to syndications and crowdfunding.
Yes, it's very similar, isn't it? Exactly.
I think one of the big differences that we're hearing, obviously, about crowdfunding and the bridge funding in the residential market is the residential market is really a different asset class to the commercial. And people, whether they know it or not, are largely playing it for capital growth.
Yeah.
Whereas people are largely playing the commercial markets for income.
Yeah, and rental growth. Rental growth.
And so the commercial tends to, despite the tragedies of the early 90s, or 89, I should say, and 2007, 2008, the commercial tends to be very, very sustainable from an income perspective and people being able to pay as they go.
Why have therefore you guys in the kind of peer-to-peer and the crowdfunding not gone after the commercial market?
I think.
Go for it.
I mean, we've done some commercial. About 25% of our book is commercial.
So here's a
so we
mix.
do a bit, yeah.
Right.
I think it's all in good people looking at commercial for income, but it did take the biggest hit on capital losses, didn't it? It's the problem with investment value on the property. It does shift its value considerably from bricks and mortar value, doesn't it? And I think that's why we're very cautious on the commercial side in terms of expansion.
Because I think that was John's point about the chart. You showed the chart. Residential did what, minus
Exactly.
14 and 25.
And I think, from what I understand, I think in terms of average commercial rents from peak to trough, they fell about 15% in the crisis. And from what I saw, there wasn't a huge amount of difference between offices, industrial, or retail. Not hugely anyway. They all fell. But the reason we went after, the reason we went after residential buy-to-let was, as again, it was we felt less cyclical than commercial real estate.
Well, I'll contradict that in part and agree with it in part. The contradiction in part, if you take any 5-year site, we do plenty of resi, but the majority of what we do is commercial. So I'm not going to rubbish either blindly, but rolling 5-year averages for any 5-year period for UK commercial real estate gave you an average of 10% nominal return per annum, of which 3/4 was delivered annually through income. So there is no doubt whatsoever there has been 2 bad years in the last 12, and there was another bad year in 1929.
Yes, that was
the
a bad year.
long run capital growth average for commercial year in, year out was 3% per average. And the long run income return net nominal is 7%. So UK commercial is by far and away, by some distance, the most stable. Residential is an equity investment.
Yeah.
And it's just a completely different ration. It's a different style of investment. There's nothing wrong with it, but it's different.
No, I just think, I mean, they're different asset classes, really.
Exactly.
I guess for us, in terms of a proposition from a peer-to-peer perspective, is people want to spread their risk.
Yeah.
So having lots of residential loans that they can spread it. Our average loan size is like £600,000. So I think, as we get scale, we offer the opportunity. If it was large-scale commercial buildings, it's a different proposition.
Stuart.
I think it's a very important point to make on the commercial side. It's true, yes, most of it is income. That's true, and you're right. People buy into buy-to-let for speculative purposes, for growth as well as income. However, lending on buy-to-let mortgages is just taking the debt side, the senior debt. You're not speculating at all. You're taking all the income first and giving them what's left, and they take the equity risk. So, peer-to-peer lenders getting involved in buy-to-let mortgages are absolutely on the right side of the line.
And where do you think the returns are going to be? Just coming down, John, what do you think your returns are going to be over the cycle in terms of buy-to-let?
So for lenders, well, we at the moment we have two very simple products, sort of fixed rate, 3-year fixed rate, and then a tracker rate. So we give lenders on our platform can either earn 4.2% on the 3-year fix, or a tracker plus 3% plus Bank of England base rate.
Stuart, on yours, I'll come to you.
Same again, we'll be delivering about 4% or so on average 60-65% loan to value debt.
Christian?
So ours is a higher yielding product. So we've sort of given investors historically 6.5% per annum, but the average loan duration is sort of 6 to 7 months. So it's liquid if investors want that, but also that could be frustrating in terms of they've got to recycle it into different loans. And
I apologise, this panel is a little shorter than we wanted because we've got Lord Young coming in a second. But Duncan, just finish with you. In a sense, looking back at the long term, from property as an overall asset class, both residential and commercial, because they are different groups. But what do you think people should be expecting in terms of total returns over a long cycle?
I think nominal, they should be aiming for about an 8 to 9% return from both.
So closer to Christian's number then.
I think,
but that's on the equity, surely. I mean,
I mean, you would expect a lower return from the debt because there's lower risk.
Yeah.
I think the makeup, this is really important, the makeup and why we've invested in both parts of both sides of it is completely different. One is dependent on capital growth, which comes and goes in cycles, and one is dependent on income and income growth, which comes and goes in cycles.
And they're different cycles.
They're very different.
I'm really because actually this is a really fascinating panel. I'd love to carry on a bit more about this. But one more from you, Stuart.
I think we've missed one major component, house building. Funding house building hasn't been talked about, and it's a huge problem in the country. with supply and demand at an extreme at the moment. And I think funding house building is the big next area that we're going to expand into. We've got a team, professional team, who do that for their whole careers, and I think that's the next big thing.
Oh, really? Okay. And again, is that something you'll be interested in as well, Chris?
Yeah, I mean, we are. We sort of do more light refurbishment work, so we don't fund full-scale developments. But I think, you know, in terms of the broad theme there is that there's a massive undersupply of new housing, and there has been for, you know, many years, actually, in comparison to population growth. So I think that's a really strong foundation for the property market.
And you're smiling because I suspect you might be all over that market.
We do a ton of it. The biggest problem with that is the planning, the government,
yeah,
the policies. The government has a central policy, but has a planning regime which doesn't support it.
Had a nice announcement today, though, to hopefully improve planning.
Okay, and on that theme of policy and government, it's probably quite a good time to take another pivot and talk a little bit about the policy agenda, and we're going to look a little bit about what government can do. But thank you very much, guys. Sorry I had to cut that one a bit short. And put your hands together and say thank you very much to our panel.